Hello everyone. Very good morning. Today our topic is bond yields, right? So before discussing the bond yields, we need to know the basic mechanism of what actually are bonds and then coupon payments, what are primary market bonds, what are secondary market bonds. So first we will discuss these basics and then we'll come to the bond yields as well as how they work, right? So you all know a bond is a promissory note there are two people involved in this. One, those who want immediately the money, right? Person A, and then person B who want to invest their savings, right? So person A want some 1,000 rupees, for example. So they will issue the 1,000 rupees promissory note, that is bond. So person B will give 1,000 rupees to the person A. So after like 1 year or 2 year or whatever may be the time period, they promise each other that we will take this bond back and we will give your money back, including the interest, right? So the interest depends on the releasing entity or the market value. So many other factors are there. So this is how the mechanism of bond works between the two entities, right? Now, there is a one more important concept, that is primary markets and secondary markets. When the bonds are issued afresh, for the first time, those are called as primary markets. For example, treasury bill issued by the government to the market. Treasury bills are the short term bonds or maybe government securities which are issued by the government for the first time, right? So these are called as the primary market bonds. And secondary market bonds are those which bonds are already in market. So the treasury bill or whatever other bonds, maybe debentures or private released bonds, already they have been released. Person A has given the bond to person B. Now person B wants some immediate money. So that person B will sell it to the other person. So this is called the secondary market, right? So bonds can be sold in primary market as well as the secondary market. So this is how the mechanism works. And from there onwards in the secondary market, so person C can sell it to person D. So it will keep on exchanging, and based on the exit and the maturity period, what the person A has promised to give in return. So the time period that was promised is called as the maturity period. And coupon payments are the payments which are given annually. For example, a bond was given for 5 years, but it was promised that coupon payments will be paid on every year, right? So the interest rate that was agreed. So these are all the yearly payments given by the person A to the person B or C, whoever holds the bond. Those are called as a coupon payments. Now coming to the bond yield concept. Bond yield means the excess amount of money earned by the persons who holds the bonds. For example, myself has bought some bond for 1 year, right? So it is a 1,000 rupees bond and there is some interest. This interest also vary. It is not a fixed one. Usually, yes, it can be fixed one, but if it is a market bond, it varies according to the secondary market values, whatever the existing demand for the particular bonds, right? So the interest rate may be varied. There will be certain fixed interest rate bonds as well, but here we are not talking about it. The fixed interest rate bonds have a standard outcome. You no need to worry about the bond yields, right? It was already agreed and the bond yields are fixed. But the market value of the interest rates may be changed based on the demand of the bonds, right? So bond yield is the value, excess amount of money that one earns when they are holding the bond, right? So for example, I have bought for 1,000 rupees and the interest rate has increased 10%. So 1 year I may get 1,100. So 100 rupees is my bond yield, right? So 1,000 rupees is what I gave and 1,100 what I got back. That 100 rupees is a bond yield, right? Now, how these bond yields are affected based on the interest rates. So there is such questions can be asked in the exam, which depends on the interest rate, right? So interest rate here, there is a lot of meaning for interest rate based on the context, but here interest rate is nothing but the amount of extra money you earn in that year by holding the bond, right? For example, there is a 5 rupees interest on the bond that I was bought. So 1,000 rupees plus 5% interest I will get from the person who has given to me, right? So that is the yield we are talking about. Here interest rate means what I am earning on holding the bonds, right? So there is a two criteria of bonds. For example, already some bonds, 10 bonds were released in the market, and some 10 more bonds may be released in the future, right? So here, as because of the lack of market condition and all, the new bonds which are going to be released, right? So those are issuing with the lesser interest rate. For example, the bonds which 10 bonds which were already released into the market maybe few days back or few years back, those are paying interest of 10%. Now, the new bonds which are going to be released maybe tomorrow, for example, imaginary concept, those are going to be given with only 5% interest. So which bonds will you prefer? Will you prefer the secondary market bonds? That means already there are bonds issued in the primary market. Or will you prefer it the primary bonds which are going to be released? Obviously, you prefer the secondary market bonds because you are getting 10% interest on holding those bonds, right? And you are getting only 5% on this new bonds which are going to be released. So if interest rate increases, right? If the interest rate increases, bond yield increases, isn't it? So interest rate that they are going to pay you will be higher. So obviously, you will try to buy it because you are getting more interest. That's why you are rejecting new bonds, right? So as the interest rate goes higher on the, interest rate which is going to be paid to you. Here, interest rate, you need to understand the context also, right? So the bond yields also increases, right? So this is one thing you need to remember because you prefer higher returns for that particular bond. So as the new bonds are going to be released with the less interest rate, the demand for existing bonds will be higher, obviously, because they are giving you 10% interest, right? So this is one point. And now, as the people are demanding more for those bonds which are already existing in the market. So as the demand increases, what is the rule of economics says, as the demand increases, the prices of those goods also will increase. Similarly, as the demand for older bonds which were already existing market has increased, the price also will increase. The price which the bond is being sold will also be increased because the demand for those bonds has increased because of this interest rate that is they are going to get in the future, right? So as the interest increased, the demand for the existing bonds increase, and the demand for the now new releasing bonds will decrease because they are paying less interest rate. So as the bonds which are already existing in the market, the prices are going increase slowly. From 1,000 rupees, someone have paid it for 1100, 1200, 1300. So the prices of the bonds kept increasing, right? Because of this increase in the prices of the bonds, so the returns that new investors will get will decrease. For example, I'm a person here who has already bought the bond A, which was giving 10% interest, right? I bought it for 1,000 rupees. So person B now he is entering into the market and now he is going to buy those same bonds which the demand has increased. Now, as the demand of the bond has increased, it will be sold at 1,200. I have bought it just for 1,000, but the new people has to buy it for 1,200 rupees. So what will happen? The returns on those particular existing bonds will decrease, right? So this is also very important point. So the what you call the returns, as the prices gets increase, as the price of bonds increase, the returns get decrease, right? But in case of interest rate, if the interest rate is increasing, interest rate here means the amount that you are getting on investing. So as the interest rates are increasing, the returns we are getting, bond yields are getting increased. And as the prices are getting increased of the existing bonds, then the yields are also getting decreased because you are now buying with the higher demand bonds, which were being sold at a higher prices, right? So these two things you need to remember related to interest rates and related to the prices of bonds. So here prices of bonds yield, the interest rate of bonds which are talking about is already existing ones. So you are now going to buy in the secondary market, right? So I'm summarizing it. As the interest rates gets increased, the bond yields also get increases. And as the prices of bonds increase, the yields get decrease, right? So try to connect all these points starting from bonds and then, working of primary market, secondary market. And then you also need to connect it to the concept of bond yield and how they are related to the interest rate and the prices of the bond. So here prices of the bond, interest of the bonds means already existing bonds in the market, right? So this is about the bond yields, right? Have a great day. Thank you.